In Chapter 13, we're going to be looking at the category of assets investments, and included in that category are long-term receivables. So we'll be looking at the various classifications of investments, debt securities. When you purchase a bond and hold it as an investment, could be classified as held to maturity, and we'll be talking about how we handle that when we buy an investment at a premium or discount. We're also going to show you two other categories, trading and available for sale, whether you were invested in debt securities or equity securities, stock. We're going to look at how we transfer between the various categories and record impairment. What happens when there's intercompany investments and you use what we call the equity method. Look at the disclosures of investments and any additional types of investments, including long-term receivables. Now, there is an area on derivative financial instruments, but we won't be covering that in this chapter. So, an investment, in the general sense, is an asset you purchase and just hold on to with the hopes it will increase in value. You may make income off of that asset, but for the most part, that is the purpose of buying it. There's two major types of investments. There's debt security investments, and these are things like U.S. Treasury securities, municipal and corporate bonds, okay, and just loans. So you can purchase a loan, and it represents a creditor relationship. The other type is equity security, and this is a financial instrument that represents ownership interest in another company. You may purchase common stock, preferred stock, stock options. That's the option to buy stock, rights and warrants, which are all options to buy stock. These are equity securities, and these are bought and sold on a market, just like bonds, treasury securities are also. A group of these items together is called a portfolio. So when you purchase investments, you may buy various debt or equity investments that have a readily determinable market value, and these are called investment or marketable securities. And altogether, we call them a portfolio. So just to give us some background on the type of asset we're talking about. So we'll be handling the accounting from the other side of the transaction, where you are the company buying the stock, buying. When a company's investment in another company is not large enough to allow the investing company, so that's us from our perspective, to control or exert significant influence, we call it a minority passive investment. Generally, these passive investments are when you own. So when we're the company that owns less than 20% of the voting stock of the investee. So that's important. At acquisition, a company will classify this passive investment in debt, which debt's always passive investment because you don't vote with debt. But from an equity security standpoint, if you own less than 20%, you'll categorize these into one of three categories based on the company's intent to hold or sell the security. So this is our first area of investments, which, by the way, has changed and your book doesn't account for it, and we'll talk about that. But we're going to talk about it the way the book does. Three categories are: if it's a debt security and you plan on holding it until it matures, so it's a bond and you're going to hold it to the maturity date, and so it's your intent and your ability, they're put into the category held to maturity. You have to have the intent and the ability to hold them as an investment. Equity securities and debt securities that are purchased and held principally to sell very quickly, 3 to 5 months. Very, very quickly, whether it's a bond or equity, common stock, preferred stock. They're put in the category trading security. And if it's an investment in debt or equity, that is not, well, debt that is not classified as held to maturity or trading. It's kind of that in-between category. Okay, or any stock that's going to be held for an indefinite period of time, they go in an available for sale securities. So here's the first thing. It's debt. All debt falls into one of these three categories. So if you purchase a debt investment, you purchase bonds, your intention is to hold it till it matures, you will put it in the category held to maturity. If you buy this bond and you are going to sell it very quickly, 3 to 5 months, you put it in the trading security. If you buy a bond and you're going to hold it more than 5 months but less than maturity, it goes in the available for sale category. If it is equity, common stock or preferred stock, it's either going, and you own less than 20% of the company, then it's either going to be a trading security, you're going to only hold it for 3 to 5 months. If it's not in that category, then it's automatically an available for sale. And if you're sitting there going, well, how do I decide? It's all on management's intention. A company reports the first thing, held to maturity at amortized cost. So we are going to be doing some bond discount and premium amortization if you purchase a bond as an investment at a discount or premium. We'll be showing you that. A company reports its investments in trading securities, whether they're debt or equity, at fair value, what they're trading for, on the date of the financial statement. And any difference between carrying value, what you bought it for, and fair value is reported as a gain or a loss on the income statement. A company reports its investments also in available for sale, also at their fair value. And any difference between carrying value and fair value is reported as a gain or a loss as other comprehensive income, which basically bypasses the income statement and goes directly to the balance sheet. That's where the change occurs. Starting in 2018, there is no difference between trading securities and available for sale. It's one category now. But we're not learning that. We got to learn the 3 different categories, sorry. Fair value provides users with more timely measures of future cash flows that could be realized from securities. So we really started doing this fair value accounting for investments back in the mid-90s. When I was in college, we didn't do it this way. Minority active investments. We talked about minority passive investments. Minority active investments are investments in debt or equity securities to establish a long-term relationship and have significant influence over the company. These types of investments usually account for 20 to 50% of the voting stock of the company. So if you're purchasing the investment, you own between 20 and 50%. You're a minority active investor. You're still a minority because you don't own more than 50% of the company. When you do own more than 50% of the company, you now control the company, and you will do what's called consolidation accounting, which you deal with more in an advanced accounting course, but we just want to let you know about that. So we're going to focus on less than 50% ownership of the stock. So this is a nice little table. It's also in your book, and it talks about how we do the accounting. So we're going to be focusing on equity securities, less than 20% ownership and 20 to 50% ownership, and then all categories of debt securities and how we will do the accounting around them. We'll look at each one specifically. So we're going to start off with held to maturity securities, which are bonds or notes. Stock does not mature, so we're looking at debt securities here. And it's when you have the positive ability and intent to hold that till it matures. How do we record it? When you purchase the investment, you debit an investment account at its cost. The investment is subsequently reported at amortized cost on the balance sheet date. So just like you amortized discount or premium when you were selling the bond, you also do the same thing when you hold it as an investment. So we'll be looking at that. Unrealized holding gains or losses are not recorded. So we don't worry about fair value. We just report the carrying value generally. So the general rule is just report the carrying value of the investment, the amortized value, if you want to look at it that way, of the investment. Interest income is recognized as net income as it is earned, along with any realized gains and losses from selling the investment. Remember, we're on the other side of it. When we're selling the bond, we pay interest. When you buy the bond, you receive interest. When you sell the bond, you will sell it either at a gain or a loss. So debt securities, such as bonds, that carry a stated interest rate, so the interest rate is above the market rate, are sold at a premium. So as an investor, you're going to be buying it for more than its face value. If the stated interest rate is below the prevailing market rate, then you will be buying it at a discount. Just like before, it's the same rule. So let's take a look. January 1, Drinkwitz Corp invests $99,000 in bonds that have a face value of $100,000, and they intend to hold them till they mature. So now they're buying these as an investment. They paid $99,000 for them. They'll receive $100,000 when the bonds mature. The day they buy the bonds, they will debit investment in held-to-maturity securities, or held-to-maturity debt securities, which is an asset, and credit cash, because they're buying the bond. They're buying that right to get $100,000 back. Now, what happens after they buy the bond? Well, they should receive interest payments, right? So they'll be receiving interest income, and they will have to recognize a part of the premium or discount each interest receipt they get, just like when we looked at the company selling the bond. So the amount of interest income recognized is based on the effective interest rate, the market interest rate, determined at the time of acquisition. How much you report as interest revenue or income, just like before. We take the market interest rate times the carrying or book value of the investment times time. That tells us how much we will credit interest income for. So the amortization, the amount we will either increase or decrease our investment for due to amortization of discount or premium. Remember, we have discount or premium because the interest rates were different. The goal is to spread that discount or premium over the life of the bond. In this case, we recognize it as income. So how much? The difference between interest income, the first calculation, and the actual cash interest we're receiving. And that amount is determined on the face value of the bond, that $100,000, times the stated interest rate times time. So let's keep going with this. Colburn Company invests in bonds that will be held to maturity. They have a face value of 100 and they pay 102,458.71. So they pay more than the face, so they purchase them at a premium. The bonds have a stated interest rate of 13%. So that's how much the company they bought these bonds from promises to pay them on that $100,000, and it'll be split up between 2 times a year, June 30th and December 31st. The bonds mature on December 31st, 2017, and the market or effective interest rate is 12% the day they buy the bonds. The day they buy the bonds, they will debit investment in held-to-maturity debt securities and credit cash. And you can follow along with this in your book if you don't want to be flipping around on the slides, page 13-7. Now, each interest payment date, they will be receiving cash. How much? 100,000 times 13% times 1/2, 6,500. They will be crediting interest income for the computation. You take the carrying value at the beginning of the interest period, which would be 102,458.71, times the market interest rate of 12% times 1/2. So the amount of interest income is 6147.52. The difference between the cash they received and the interest income recognized is how much they will decrease their investment account. And if you think about this, every interest payment period, when you have a premium, you want to decrease the carrying value until it reaches the face value. You do the opposite when you purchase or sell a bond at a discount. So each interest payment period, the investment account will be decreased before the portion of the premium being amortized. Now, what happens if the opposite? Now they're buying them at a discount, 97,616.71. Well, you're still going to debit the investment and credit cash. But now the effective interest rate or market is higher than the bond stated rate of 13%. So that's why they're selling at a discount. Coburn could have taken their money and invested it in a bond paying 14%. How did they why did we buy the company bonds only paying 13%? Because we bought them at less than face value. We still follow the same scenario though. The cash doesn't change. The face value is 100,000. The stated interest rate is 13%. Those are on the bond certificate. Paid twice a year, so half of it we get at the first interest payment. 6,500 cash. Determining the interest expense, same method. You take the beginning of the interest period, carrying value, 97,616.71. Multiply that by the market interest rate of 14%. Multiply that by 1/2. So the amount of the interest income would be 6833.17. How much of the discount is amortized? 333.17, the difference. We actually debit the investment because we're trying to increase it up to the face value. So you don't keep a separate discount or premium account when you hold an investment. You just increase or decrease your investment account for that discount or premium, amortized for that interest period. Okay. So that's what happens. What happens when you purchase a bond in between interest dates? So Talon Company purchased 9% bonds with a face value of $200,000 at par, plus they had to pay for accrued interest on March 1st, 2018. Why? Well, the interest payments are made on June 30th and December 31st. If they bought this bond on December 31st, January 1, there would be no accrued interest. But they bought the bond March 1st. Interest has been accruing or occurring on this bond January and February. Who's going to get the interest on June 30th? Talon will, because they will own it. So they have to pay up front on the purchase date for 2 months of interest. So let's take a look. They will debit investment in held-to-maturity securities, $200,000. They will debit either interest receivable or interest income. For how much? $200,000 times 9% times 2/12, which would be $3,000. So of the $9,000 in interest they'll receive on June 30th, $3,000 of it is an interest income to them. They pay for that up front, and you can see they credit cash $203,000. When the first interest payment is received, they'll debit cash $9,000 and credit interest income $9,000. That debit of $3,000 will offset the $9,000 to truly reflect the interest income that they're entitled to for those 4 months they actually owned the bond. What happens if they sell it prior to maturity? Well, let's take a look. On March 31st, Culber & Company sells the $100,000 13% bond they had classified as held to maturity. They sell it at $102,000 plus accrued interest. The bonds were purchased January 1, 2018 for $97,616.71. The effective interest was 14%, and they have a maturity date of December 31st, 2020. We have to use the effective interest method to amortize the discount up to the date of sale. So, the amount of the interest, if you look back on page 13-8, there is actually an amortization schedule there. As of December 31st, 2018, if you look at the schedule, go all the way across, the carrying amount of the bond on December 31st, 2018 was $98,306.37. They're selling these bonds March 31st, 2019. So they're selling them 3 months into the next interest period. So they should record those 3 months of interest as a reduction in the as an increase. They have to amortize, I should say, the discount for those 3 months. Now, I'm not too thrilled with the way they do that, but it's really what is being said on page 13-8. Another way of doing that is you can look right at your amortization schedule and say, okay, the next 6 months of interest, I will be reducing my investment account $371.45. That represents 6 months of amortization. How many months do I have to amortize of that 6 months through the date of sale? Well, January, February, and March, so half of it. So if you take half of $381.45, it's $190.72. The point is that you must amortize that discount or premium and increase your investment account to the point of sale. So if you haven't done that by then, you must do it. And that's what we're doing here, debiting the investment and crediting interest income. Then, in the second journal entry, Colburn collects not only the cash from the sale, but also the interest that has been earned in the 3 months. Because remember, they're entitled to that. They've held that investment for 3 months, but they're not going to get any of it from the company that sold them the bond. The new owner is going to get all 6 months. So they're going to require the new owner to pay them their portion of the interest that they're never going to receive, or 3 months of it. So $100,000 times 13% times 3/12. So on the day they sell the bond, they'll be getting cash of $102,000, what they sold it for, plus $32.50. They'll credit interest income for $32.50, their portion of interest that's been earned. They will credit the investment account for its current carrying value. Now, if you're looking down there going, well, it's only $98,306.37. Add the $190.72 to that. Now it has a current carrying value of $98,497 as of the date of the sale. So the difference is the gain on sale of a debt security, the difference between what they receive in cash of $102,000 minus the carrying value of $98,497.09. The difference is the gain on the sale of the investment. So that's how we handle held to maturity investments, which are bonds. When you buy them as an investment, and you hold them till they mature. All investments in equity securities are trading securities. Investments in debt securities are trading securities when they are actively bought and sold with the intention to profit on short-term changes in price. The accounting for trading securities applies the fair value measurement approach. What does this say? We always record the investment at what we originally bought it for. And then we report the investment at fair value when we report it on the balance sheet. Any difference between the carrying value, what we originally paid for it, and its current fair value is recorded as an unrealized holding gain or loss on the income statement. Any interest or dividends the company receives, or any gains or losses from actually selling the investment, are reported in net income. Remember, a trading security for equity, you own less than 20% of the company. Now in this one, it says all investments in equity securities are trading securities. So, no. So let's take a look. The accounting for trading securities is illustrated as follows. May 1st, Morgan Company purchases Able Company common stock, 100 shares, $50 a share, $5,000. Baker Company common stock, 300 shares, $80 per share, $24,000. Charlie Company preferred stock, 200 shares at $120 each, $24,000. And then they buy Delta Company 10% bonds, face value of $15,000. They acquire them at par, $15,000, and then they tell you about the interest. So they paid a total of $68,000 for all these investments, and you can account for them all in one account. So you'll debit investment in trading securities, which will always be a current asset, and credit cash. Remember, trading securities, the intention is to sell them very quickly. When you receive interest income related to investments in debt securities, it's recorded as it is earned during the period. Thus, interest income should be accrued as time passes if you need to. So on May 31st, Morgan Company accrues 1 month of interest on the investment in Delta Company bonds because they've earned 1 month of interest, and they may have to record it in order to have an adequate financial statement. Debit interest receivable, credit interest income. On October 31st, Morgan receives this first semi-annual interest payment of $750 and records it as a debit to cash and a credit to interest receivable. Sorry, just give me a second. Oh, the assumption is that they have been accruing interest every month since they bought it. Sorry about that. If they've been accruing the interest every month at the end of the month, June, July, August, September, then when they do receive the interest payment, they'll debit cash and credit interest receivable. If they haven't been, then a portion of that needs to be recorded as interest income. Morgan records the $3,000 of dividends they received from the companies as a debit to cash and a credit to dividend income. So you do nothing with the investment account itself. Now, at the end of the year, when the company's getting ready to do a financial statements, when it comes to trading securities, the company will determine the fair value of each trading security. An increase in the fair value is an unrealized holding gain. A decrease from the carrying value to the fair value is an unrealized holding loss. For investments in trading securities, the unrealized holding gain or loss is a temporary account that is close to retained earnings. So that means it goes on the income statement. A debit balance is an unrealized loss, and a credit balance is an unrealized gain. So if we look at the securities that are in the trading securities category as of December 31st, 2018, the total cost were $68,000. Now the company went and found the fair value for each. Overall, the fair value is $71,000 for the securities in the trading security category. The difference is a positive $3,000, so they're worth more than they were when they were purchased, and the amount that they're recorded for currently in their T account. So the journal entry would be a debit to investment in trading securities, increase that account $3,000, and credit an unrealized holding gain or loss trading securities. And the important thing to remember as of right now in this book, that is recorded as an item on your income statement in the other income and expense area. What if the opposite occurs? What if the fair value was less than? Well, you would do the similar type of journal entry, but this time you would debit unrealized holding gain or loss because it's a loss, and then credit or decrease the investment. It currently has a $71,000 debit balance. It needs to be reflected as 66, so you have to decrease the investment account for this loss, so that the amount reported on the balance sheet is the $66,000. Now, what happens on March 1st, 2020, when Morgan sells the 100 shares of Able Company common stock for $6,000? Remember, the fair value at the balance sheet date was $6,100. Well, we have to credit the investment account for the $6,100, what it's currently listed at in the T account, which was the last fair value. Debit cash for $6,000, and then the difference would be a loss on the sale of trading securities. Now, at the end of 2020, Morgan would report the fair values of the securities as follows. So the fair value at the end of 19 and the fair value at the end of 20 would be $59,900 compared to $62,300 for the remaining items they have. So, and that would be also the balance. The fair value at 12/31/19 should be the current balance in the trading securities investment T account. We needed to have a $2,400. So we would debit the investment in trading securities and credit unrealized holding gain or loss for that $2,400 difference. And then the new balance would be the fair value as of 12/31/2020. Remember, trading securities are equity investments that you hold less than 20% of the voting stock, or debt securities. Both you have the intention to only hold them for a short period of time, 3 to 5 months, and you're going to sell them. The last category is the available for sale securities. Now, whether you're buying debt or equity, the investment is usually recorded at cost. The investment is subsequently reported at the fair value, whether it's debt or equity. Any unrealized holding gains or losses due to changes between carrying value and fair value are reported, though, as a component of other comprehensive income as of this class in this book. However, going into 2018, this is the first year, this category has been eliminated. But you want to learn about it? You never know when it could come back. The major difference between available for sale and trading securities is where the unrealized holding gain or loss is reported. For trading, it's reported right on the income statement. For available for sale, it never goes on the income statement. It's reported as other comprehensive income and goes directly on the balance sheet. So you'll never see any effect on net income from it. Interest income is reported as it always has been. And when a security is actually sold, the gain or loss is reported on the income statement. And any unrealized holding gains or losses are reclassified from comprehensive income into net income. So let's take a look at that. On January 1, Morgan Company purchases bonds for $195,000, debit investment, credit cash. and these are available for sale category. They're going to hold them more than 3 to 5 months. That's their intention, but they're not going to hold them to maturity. On June 30th, when the company receives its first semi-annual interest payment, they use straight line to record any bond discount in this case. They're going to debit cash for $200,000 times the interest rate of 10%. And if you're like, where did this stuff come from? Remember, this is always in your book. And this was on page 13-14. And the information is in the center block. So the bonds have a face value of $200,000, an interest rate, stated interest rate of 10%, and the interest is paid twice a year. So the first interest payment will be $10,000 Morgan receives. They'll credit and they'll also debit their investment. They'll start amortizing on a straight line basis. They're not doing the effective interest method like we did under held to maturity. You can, but you could also use straight line. So they're going to take the amount of discount one time, $5,000 difference between face and the amount they bought it at. The $5,000 is spread out over 20 interest payments. 10-year bonds, interest is paid twice a year. So you'll debit every interest payment you receive, investment in available for sale securities, $250. Add those two together, credit interest income, $10,250. Notice that any amortization of discount or premium is recorded directly to the investment account, just like we saw before. Now, at the end of the year, when we're getting ready to do a balance sheet, the company determines the fair value of each security. And any difference for investments in available for sale is reported as unrealized gain or loss in other comprehensive income. A credit balance in this account represents a cumulative net unrealized gain. A debit would be a loss. Both are reported as comprehensive income in shareholders' equity. So on December 31st, after they amortized that first interest payment and the second, so they received 2 interest payments so far, and they've amortized the discount twice. So the new carrying value in the investment, so they would have debited their investment account $250 at the first interest receipt and $250 at the second interest receipt, is at $95,500. The bonds are currently selling for $199,000. So the difference is a $3,500 unrealized holding gain or loss. We do not debit the investment account directly for this. We debit a contra account, or in this case, an adjunct account, allowance for change in fair value of investments. Since it has a debit balance, it would be added to the investment's debit balance of $195,500, so that you're reporting $199,000. So instead of debiting the investment account directly, because we want to keep track of the carrying value, the true carrying value as we amortize that discount, we store the difference between current carrying value and fair value in a separate account. And that account is either increasing the investment account or decreasing depending on its current balance. Morgan reports the investment as an asset at the $199,000. So they'll be taking their current investment account balance of $195,500 plus $3,500 in the adjunct account allowance for change in fair value and the $199,000. The $3,000 is reported after net income in other comprehensive income. On December 31st, 2019, the fair value of the investment is $198,000 and the balance in the investment account is $196,000. Once the company has established an allowance account, it determines the amount of the year-end adjustment in a subsequent period by comparing the required amounts of the allowance account with its previous balance. What are we talking about? The required amount that's needed as a balance in Morgan's allowance account would be a $2,000 debit balance. The current fair value is at 198. The current carrying value of the investment account is 196. So we would need that allowance to change to market account to have a balance in it of 2,000. It currently has a debit balance of 3,500 from the end of last year. So we would need to actually debit it 1,500 and credit the allowance for change in fair value of investments to decrease that account so it has a debit balance of $2,000. Again, we would be reporting these items in the unrealized holding gain or loss in comprehensive income. Now, what happens when we sell an available for sale security? Well, on March 1st, 2020, Morgan sells its investment in available for sale securities. It originally cost $195. It's amortized up to the date of sale of $196, $125. So everything's been recorded through the date of sale of March 1st. And it sold for $197 on March 1st, that's supposed to be. So they'll debit cash $197, credit the investment for its amortized cost of $196, $125, and the difference would be a gain on sale because they sold it for more than its current carrying value. They will also remove the accumulated other comprehensive income component. So that's the $2,000. So they need to credit the allowance for change in fair value because we got to get rid of that contra account. We no longer have that investment. Why would we have an allowance for change in fair value? Credit that, and we would debit the unrealized holding gain or loss for $2,000. And you could read through that, explaining it a little more. Okay, so those are how we account for investments that are held to maturity, which are bonds. We initially record them at cost. We report them on their balance sheet at their amortized cost. So we increase or decrease them for that period's amortization of discount or premium, and that's how they're reported. There's no unrealized gain or loss. Any interest is recorded as net income, and when we sell it, any gain or loss from the sale is reported in net income. It's reported on the income statement. Trading securities are initially recorded at cost. They're reported on the balance sheet at their fair value. The difference between cost and fair value is an unrealized holding gain or loss recognized on the income statement. Any interest or dividends related to these investments are reported on the income statement, as well as any gains or loss on their sales. Available for sale is the tricky one, and that's the one going away. We report them at their cost. We report the value as fair value on the balance sheet. Any difference between cost and fair value is reported as unrealized holding gain or loss comprehensive income. So it does not go on the income statement directly, does not affect net income. However, interest and dividends related to these securities do go on the income statement, as well as realized gains or losses from the actual sale. Great little chart to have in front of you. What happens if we transfer investments between categories? Well, the transfer of a security between investment categories is accounted for at fair value at the time of transfer. The accounting for any unrealized gain or loss depends on the type of transfer. So if you're transferring from the trading category into any other category, there's no accounting for the unrealized holding gain or loss because it has already been shown in net income. A transfer into the category, though, into the trading category, the previous unrealized holding gain or loss is immediately recognized in net income and taken out of other comprehensive income. So from the trading, no effect on net income. Into the trading, immediately expense any unrealized holding gain or loss, show it on the income statement. A transfer into available for sale from the held to maturity. An unrealized holding gain or loss is established and included in other comprehensive income. So you've got to create an unrealized holding gain or loss. A transfer of debt security from available for sale into held to maturity. You continue to report the unrealized holding gain or loss as a separate component of comprehensive income and amortize it over the remaining life of the security. So that's a funky one. So you got to be very careful. You can transfer between categories, but you just have to remember what you need to do to accomplish that correctly. Take a quick example here. High company purchased bonds. They classified as available for sale investments. The bonds have a face value of $5,000 and were purchased at par. The bonds had a fair value at December 31st, 19 of $6,100, which resulted in an unrealized gain of $1,100. In 2020, when the bonds had a fair value of $6,300, they transferred the bonds into the trading category. They will debit investment in trading $6,300, credit the investment in available for sale securities $5,000, that should be the original purchase price, and then credit gain on transfer of securities $1,300. Immediately recognize that. In this entry, the investment in trading securities is recorded at its fair value and the cost is removed. The realized gain is included in net income in that year. At the same time, High eliminates that unrealized holding gain or loss. So they're going to remove the unrealized holding gain by debiting it, and they're going to get rid of that adjunct account allowance for change in fair value of $1,100. Where did that come from? Well, at the end of 2018, or 2019, I should say. That should say 2019, not 2017 up above. They originally had reported the investment at its fair value of $6,100 on the balance sheet. So on the balance sheet, it was worth $6,100. They bought it for $5,000. So they had to increase the value by debiting the allowance for change in fair value $1,100 and crediting the unrealized holding gain available for sale $1,100. Now they're reversing that to get rid of those two balances. Transferring into available from held to maturity. Devon has bonds with a face value of $10,000. It purchased them at par, keep it simple, and it's classified as an investment in held to maturity securities. When the fair value of the bond is $9,500, Devon transfers the bond from available for sale from held to maturity to available for sale. Debit the investment available for sale $10,000. Credit investment in held to maturity securities $10,000. The difference, because they are going into available for sale, we must debit the unrealized holding gain or loss to now affect that they were transferred in at a fair value of $9,500 and credit the allowance for change in fair value of investments $500. Transfer into held to maturity from available for sale. So it's great to review all of these. Assume Devon's bonds are currently classified as available for sale and it transfers them into held for maturity, which is more realistic. You buy them, you're not sure, and then you're like, yeah, we'll hold them to maturity. Okay. The bonds had a fair market value of $9,700 the last time they reported them on the balance sheet. The current fair market value is $9,500, and the transfer is recorded as follows. They're going to debit the investment in held to maturity securities for $9,500. They'll credit the investment in available for sale $10,000, and they're going to debit the unrealized holding gain or loss of $500. So they transfer them in at their current market value, and they only reduce the holding gain or loss for the difference between what the investment's carrying value is and the current market value. They leave the other $200 that was sitting there from last balance sheet date in the unrealized holding gain or loss held to maturity. And then they have to remove, there it is coming out. They're removing any unrealized holding gain or loss that was recorded. They reverse it. I'm sorry, I was wrong. They reverse that entry that was made. Okay, enough with transferring from categories. Let's see what happens if there's an impairment. So each reporting date, a company should evaluate its investments to determine if there's an impairment. They'll determine whether an investment is impaired, evaluate whether it's temporary or permanent, and then if it's other than temporary, they have to recognize a loss for the difference between the cost of the investment and its fair market value. Pretty normal to what we've seen in the past. Tracy Company is a bond investment categorized as held to maturity, has a current carrying value of $21,500 and a fair value of $6,500. They determined that that decline of $15,000 is not going to be recovered. It's permanent. What do? They debit realized loss on decline in value, which will be on the income statement, credit investment in held to maturity securities, $15,000. The $6,500 fair value becomes the new carrying value of the security. Tracy computes interest income using the effective interest method based on the new effective interest rate computed. Okay, very straightforward with impairments. So, we are done with less than 20% ownership and debt. Now let's look at you own 20 to 50% of the voting stock of another company. You are now a minority active investor. You usually can influence decisions. You have significant influence. You don't have control. You don't own more than 50%, but you own between 20 and 50% of the company. When an investor company owns a large percentage, it is able to exert significant influence over the financial and operating policies of the investees. That only makes sense. It's determined by factors such as, do you have representation on the board and participation in policy-making processes? And there's some others listed on page 13-23. In the absence of proof of those factors, they usually rely on a percentage of ownership, as I said, 20% or more. The equity method then is used to do the accounting for that investment. Panther Company purchases 4,200 shares or 25% of Salsa Company. So right there, we own more than 20%. We have significant influence. The day you purchase it, just like any other time you purchase an investment, you debit the investment account for cost, credit, cash. Now, there's something else that we need to worry about. Panther paid $125,000 for the shares. And on the date of the acquisition, they found out the following about Salsa. Salsa's fair value of its assets are $696,000, and its liabilities have a fair value of $220,000. Now, what else is happening? Salsa paid a $20,000 dividend in August, and they had reported net income of $81,000. The day that they pay for that investment, they will debit the investment in stock, $125,000, and credit cash for the amount paid. Panther's entry for receipt of the dividend will be a debit to cash of $5,000. Why? Salsa paid a total of $20,000 to all of its shareholders. Panther only owns 25%. So they're only receiving cash of $5,000. They'll credit not dividend income, but the investment account. So under this method, whenever the investor receives a dividend from the company they own, they credit the investment account. At the end of the year, when Salsa reports its net income, Panther will debit the investment account for 25% of the net income, or $20,250, and they'll credit an income account, investment income, which is reported on their income statement for their share of Salsa's net income. You have to remember something. When you own less than 20% of the stock of another company, you don't significantly influence them all. As you receive a dividend, you will report income from that company. But when you significantly influence it, the accounting gods out there feel you have more control over the net income part as much as the dividends. So as the company earns its income, you should report your proportionate share as income, not wait until you actually receive a dividend. So that's why we credit investment income for the Panther's proportionate share of CELSA's net income as they earn it and debit the investment account. As CELSA pays dividends, we don't report those dividends as income, we just reduce the investment account. They're now getting paid back part of that $20,250 in net income. Because the fair value of CELSA's depreciable assets exceeds their book value. Okay, so if you take a look on page 13-24, the depreciable assets, the book value is $400,000. The fair value is $450,000. So the day that Panther purchases CELSA, they actually are buying or paying for value that's more than the book value. They're actually, their $125,000 is part of the depreciable assets values of $450,000, not $400,000. That's what they're buying here. They're buying the net assets as of the date where they're valued at $450,000. When CELSA reports their income on their income statement, though, they're only deducting depreciation expense on $400,000. So that $81,000 that they reported, which is correct, that's what they're supposed to do, Panther is reporting 25% of it. But really, Panther, and well, if we truly want to report the amount of income Panther should report, it should be CELSA's net income minus the excess depreciation that should have been taken because the assets should have been depreciated at their fair value, not their book value. So because of that, what we do is we say, okay, the day Panther bought CELSA, depreciable assets had a value of $450,000. CELSA's only depreciating assets that have a value of $400,000. So the difference of $50,000 still needs to be written off. And it'll be written off over 10 years, the remaining life of those assets. So Panther will record an additional amount of depreciation on their books, where they will decrease the investment income and decrease their investment account. Now, if you're sitting there going, why is it only $1,250? Well, the $50,000 difference is on 100% ownership. They only own 25%. So they report actually they'll report an additional total amount of depreciation of $12,500 over 10 years. This year, $1,250. So they decrease the amount of income they're actually reporting from CELSA by $1,250 and decrease their investment in stock in CELSA. $1,250 because of this difference. I know it's funky, but that's how it's worked. So let's take a look at this again. Acquisition price is $125,000. That's how much the investment account will be debited for. They'll increase their investment account for their proportionate share of reported net income of CELSA, which is $20,250. They'll decrease the investment account for the dividends of $5,000. We saw that. And for that excess depreciation due to the difference in book value and fair value at the date of acquisition. So the carrying value of the investment account, what would be the balance at the end of 2016? $139,000. That's what they'll report it on the balance sheet at. And the income, and the overall net investment income that will be shown on their income statement because of their investment in CELSA will be $19,000. And that's how you account for equity. There's no fair value unless there's a permanent impairment. If there's bankruptcy of the investee, lengthy declines in the fair value of the stock, a number of years of operating losses, when the decline is considered to be other than temporary, the investor debits a loss account and credits the investment for the difference between the carrying value and the fair value. And the fair value would be very easy to determine because of the difference in stock prices. If the investment recovers, we don't do anything to write it back up. It's ignored. Now, the last major area I think that we're going to talk about here, is changing to equity, the change to the equity method. I'm not going to spend a huge amount of time with this. In an advanced accounting course, you will be learning this as well. When an investor currently using the fair value method acquires enough additional common stock to obtain significant influence. So let's say for many years you've owned the stock of a company and have accounted for it as a available for sale security, and you own 15% of it. And this year you bought 15 more percent, and now you own 30%. Well, now you have to change the way you do the accounting. When the equity method is adopted, the investor restates its investment in the investee by debiting the investment account and crediting retained earnings for the previous percentage of investee income minus dividends for the period from the original date of acquisition to the date that significant influence was obtained. That's how it currently works. It actually has changed. In 2018, it's a prospective change, meaning you don't have to do this step. Once the necessary adjustments have been made, the equity method is applied going forward. Now, that makes no sense unless you see an example. Short Company purchased 15% of the outstanding stock of Jones Corporation. It's classified as an available for sale. At the time, Jones' book value of net assets was $1 million. Okay, so they owned 15% of it. They bought it, $150,000. Cool. They paid for it what it's worth. At the end of 2018, Jones reported net income of $300,000 and paid dividends of $60,000. That's great too. That doesn't matter to us. We're accounting for this under the fair value method right now. And then there's the market value. So at the end of the year, the market value is $36,000 higher. Now, if you want to see the examples of this and follow this along, it's on page 13-27. So if you want to refer back to any of the details of this. On January 2nd, Jones purchased an additional 25%. So now it's a 40% stockholder, and they bought it for $310,000. Let's see how this affects us. Here are the journal entries. During 2018, that we are properly accounting for this as an investment in trading securities. You debited that for $150,000 credit cash when you purchased it. When the company paid dividends. Now remember, it paid a $60,000 dividend, but you only owned 15%. So you received $9,000 of it. You debited cash, credited dividend income $9,000. At the end of the year, when the market value was at $186,000, you debited investment in trading securities for $36,000 and credited unrealized holding gain or loss, which went directly on the income statement, for $36,000. Now, what happens going into 2019 when now you can exert significant influence and you have to start accounting for this as an equity method? Well, first you're going to debit investment in stock, Jones Corporation, $310,000 in credit cash. Then you're going to debit investment in stock, Jones Corporation, for the current balance of the investment in trading securities, which would be the $186, the $150 plus the $36 you added at the end of last year. Credit the investment in trading, debit the investment in Jones stock. Page 13-28 will help us with these next items. On the same day as you purchase it, you will debit investment in stock, Jones Company, $45,000, and credit retained earnings, $45,000. What does that represent? Well, during the year, the company had net income for 2018 of Jones Corporation was $300,000. 25% of it would have been, 15% of it, if we applied the equity method last year, would have been debited to the investment in stock Jones Corporation and credited to an earnings account, an income account. So what we're saying here is that we have to look back to last year or the prior years when we were using the fair value method and make a journal entry as if we were using the equity method. So last year, if we were using the equity method, 15% would have been debited of the net income, would have been debited to the investment in stock and credited to an income account, which was closed out to retained earnings. So since it's from last year, we credit retained earnings. What else would have happened? Well, we would have never recorded dividend income of $9,000. Last year, we included that in net income. We want to take it out like it never happened. So we debit retained earnings and instead credit investment in stock corporation because that's what we would have done with that dividend, decreased the stock investment account. What else wouldn't we have done? We would have never written the investment up to fair value. So we want to take that $36,000 out of the investment in trading securities and debit retained earnings. We would have never shown that in income last year. So any items that affect the income statement from last year would be accounted for in retained earnings, like a prior period adjustment. But that's how you would change it from a fair value method to the equity method. These calculations are on page 13-28. So the new balance in investment in Jones would be $496,000. The basic disclosures you have to make are definitely the fair value, any change in net unrealized holding gains or losses, and in available for sale, you're going to report fair values, gross unrealized holding gains and losses, as well as amortized costs. And you could read through the basic items that go on the income statement related to investments. I'm getting kind of lengthy here with my discussion. So those are good read-through items on pages 1329 and 1330, and a great disclosure on page 13-31 and 32 for you to look at how detailed we get with reporting investments. The final area of our discussion, though, deals with other types of investments besides investing or purchasing stocks or bonds. Sometimes we buy loans or we make loans. So let's look at long-term notes receivables. This is recorded at the fair value of the property, goods, or services or of the note, whichever is more clearly determinable. If neither of them, we use the borrower's incremental interest rate and determine the present value. Take a look. Joyce Company accepts a $10,000 non-interest bearing, there it is, 5-year note on January 1st in exchange for used equipment. It's sold to Marsden Company. So, Joyce sold to Marsden equipment. Marsden gave them a note, $10,000 note, non-interest bearing, due in 5 years. Marsden's incremental borrowing rate is 12%. So we will discount this note of $10,000, 12% interest, 5 years. Its present value is $5674.27. So the equipment cost $8,000 and has a book value of $5,000. The journal entry then would be debit notes receivable for the $10,000, credit the discount on notes receivable for the difference between the face and the present value. Debit equipment, credit equipment $8,000, the original cost, and debit the accumulated depreciation of $3,000, which would give you your $5,000 book value. The difference would be recorded as the gain on sale of equipment, $674.27, or the present value of the note minus the book value of the equipment. That is how you determine your gain. Now, at the end of the first year, the company will recognize interest. Remember, a discount on notes receivable is really an account holding all the interest on this loan. It's just that you're not receiving it in cash as you go. You loaned less than you'll receive at the end. So you get it all in one shot when you collect on this loan. So over the next 5 years, you should recognize a portion of that discount on notes receivable as interest income. What portion? Well, take the balance or the carrying value of the note receivable, which is the note receivable minus the discount on notes receivable balance, and multiply it by your interest rate. So for the first year, it'll be $680.91. That next one is wrong. The next one should be $10,000 minus, it would be $4325.73 plus, or I'm sorry, minus $680.91. And I don't mean minus that twice. So the current balance after you debit discount on notes receivable would be the original balance of discount on notes receivables of $4325.73 minus the $680.91 you just amortized or recognized. So the current balance in the current balance on discount on notes receivable is 36, a credit of 3644.82. Subtract that from 10,000. So the current carrying value, which is what you determine interest on, would be 6355.18. Multiply that by 0.12, 12%, and you get 762.62 as the amount of interest. You'll recognize debit the discount, so you're reducing this discount on notes receivable, and credit interest income. And you'll do that for each one through the life of the loan. The non-refundable fees charged to borrowers for lending activities that precede the payment of funds and generally include efforts to identify and track potential borrowers are loan origination fees. Generally, any loan fees are deferred and recognized as income. So if you charge someone these, they're recognized over the life of the loan. They're like an unearned revenue. A loan is impaired. Okay, so that was just very quickly on that. What about impairment on a loan? It is impaired if it is probable that the creditor will be unable to collect all amounts. Impairment occurs when there is delay or reduction in the payment of principal or interest unless you expect to collect all the money. The creditor recognizes the amount by which the present value of expected future cash flows from the loan is less than the recorded investment in the loan. And you'll recognize it as bad debt expense. So Snook Company has a $100,000 8% note receivable from Ullman. Interest is payable each December 31st, and the principal is paid on December 31st, 2021. Ullman paid the interest due on December 31st, 2016, but informed Snook it probably will miss the next 2 years' interest due to financial difficulties. So under the old payments, this is what they're receiving. Under the new payments, that's what they're receiving. The present value of which is only $85,733.93. So on December 31st, Snook computes the present value of the impaired loan for a 6-year period from December 31st, 16 to December 31st, 2019. The interest is discounted for only 4 years, deferred 2 years. So the present value of the principal, $63,017. The present value of the interest, $22,717. So how much are they going to be receiving? $85,733.93. That's the total value of the impaired loan. So since the carrying value is $100,000, the new value that they expect, present value is $85,734, or that's the fair value. The difference would be debited to bad debt expense, credited to allowance for doubtful notes. Just like you do for accounts receivable, you would do the same for notes receivables, and that's how you determine it. And you could read on with that. And you could read through cash surrender value as well, what it is and how we do the accounting for it. Any questions you may have, you can post. But these are more off to the side kind of items that aren't a major part of the chapter. Okay, so I'm going to wrap up Chapter 13's discussion on investments and long-term receivables. Any kind of questions you may have, please post in the discussion board. Again, more information about investments in long-term items to fund future payoffs. And you could read through that. And that's where we're going to end.